Namaskar friends, welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to discuss our strategic management and innovation. This is a certification course conducted by IIBF, memory based question for the examination which was held on 11th July 2026. And if you have not seen our previous videos based on memory based question, you can check out the link in the description section. I have created more videos through which you can check out the level of the paper and what are the important topics. So let's get started with our very first topic. So the first question is that they have given you a situation regarding XYZ Bank, right? So basically, XYZ Bank decided to step away from the highly saturated retail loan market. So what they have decided? They have decided to step away from the highly saturated retail loan market where everyone is fighting over interest rate. You know what is happening in this retail loan market? Everyone is fighting over interest rate, right? And basically what they do, they launch a brand new micro lending platform. They launch a brand new micro lending platform directly for rural art agriculture supply chain. This is a completely untouched area. The question asks, from a strategic management perspective, this represent a shift from option they have given: blue ocean to red ocean, market penetration to market development, red ocean to blue ocean, cost leadership to differentiation. These are the options they have given. Let me explain. So let's break this down without the complicated business term. Think about the retail loan market, right? Every bank is there. Everyone is slashing interest rate, right? Everyone is slashing interest rate to grab a single customer, right? Imagine a small pond filled with a hungry shark fighting over the exact same fish. So this is the same fish, and there are many sharks: Shark 1, Shark 2, Shark 3. This is a pond. So because of all the aggressive biting and fighting, the water turned red. The water turned what? Red. Water become red. Why? Because of the biting and fighting. That is what we know. We call red ocean strategy. This is called red ocean strategy. So which means competing in an overcrowded existing market. So you are competing in an overcrowded, right, existing market where you survive by beating the competition and cutting the price, right? So the overcrowded and existing market, how you will survive? You will be survived by beating the competition and cutting the prices. This is how you will be surviving. Now what XYZ Bank do? They stop fighting. If you look at this particular question, let's come back to it. And what it is telling, that they stop fighting, right? So they swam away and discovered a massive blue, beautiful, untouched body of water. Yeah. So what they did, they stopped fighting, no longer fighting, right? And that they discovered a massive, beautiful, untouched body of water, right? The rural agriculture supply chain. This is the untouched, something untouched. Rural agri supply chain. So there are no other banks there, no shark there, right? No shark are there. The water is peaceful, clean, and blue, and that is called blue ocean strategy. That is called blue ocean strategy. Creating a brand new uncontested market space where the competition is completely irrelevant because you are the only one there. You are only one there. That's it, right? So what is the memory trick to remember? To make you never forget this in the exam hall, just remember this simple trick. And what is that? The simple trick is that whenever you think about the red ocean, right, think red ocean like ruthless, right, ruthless, exhausting, and deadly combination. You can think of them like ruthless, exhausting, and deadly combination. Right? Think of a bloody prize war. And then when I talk about the blue ocean, how do you think about it? You think about the brand new, limitless, uncontested, empty of competitor. Think of calm, open water, right? So now, in this particular case, because this XYZ bank has left the saturated retail market, then right, they have left the saturated retail market to pioneer. So basically, the saturated retail market is the red ocean. They have left the red ocean to pioneer the untouched rural market, and this untouched rural market is called the blue ocean, right? So they made a brilliant strategic move, and therefore the correct answer is red ocean to blue ocean. It is that much simple, right? Lock this concept in your memory and you will easily secure your marks whenever this topic appear. Keep studying smart. Right, now let's see the next question we have. So question number 2 is on your screen, as you can see. So basically, here is the problem. What is happening, the asset liability committee of a commercial bank noticed a shrinking NIM. So what is happening, the NIM, the bank net interest margin, right? So this, this is the bank net profit. This is the bank, net profit margin, and it is shrinking. It is continuously shrinking. Okay. So, and one more topic they have given, why it is shrinking? Because of the rising short-term deposit rate, right? Rising short-term deposit rate and also long-term loan portfolio, right? So these are the phrases that they have mentioned. So bank NIM is sinking because the interest they have to pay out to depositor is going up, right? So the deposit interest is going up, and money that they are earning for long-term loan is locked in the old lower fixed rate. Whatever money they are earning from long-term loan, they are fixed at old lower fixed rate. So the question is asking, what is the primary strategic action that ALCO should take to manage this mismatch? Obviously, there is a mismatch. They are not getting to collect so much money from the long-term loan because they remain locked at the fixed rate. And also, interest they have to pay at the deposit, it also going up. So this is not a mismatch. This is completely mismatch. Option they have given: increasing the marketing budget, restructuring the liability profile, revise the pricing strategy for new loan, immediately write off a portion of the long-term loan portfolio. So friends, how do you go about solving this problem? So let's completely remove the banking jargon for a second, right? Imagine that you are a business supplying coffee to an office. Suppose you are in business and you are supplying coffee to an office. Okay, a year ago, you signed a 5-year contract to sell the coffee at a fixed rate of 100 rupees per cup. This is your fixed long term loan. This is your, that is your fixed long term loan. But suddenly, what happened? The wholesale cost of the coffee bean start rising every month. Those bean are your short term deposit, isn't it? Those bean are your short term deposit. You are paying more and more for your raw material, but you are stuck at charging the same 100 rupees to your customer. See, you are paying more for coffee bean, but you are stuck at 100 rupees for the per cup, and that is your that was called, and you are stuck, right? So your profit margin is vanishing. Obviously, whatever margin you accumulate, that is decreasing continuously. So if you are the boss, if you are the ALCO, how do you fix this? Tell me. If you are the boss or ALCO, how will you fix it? First of all, you will stop the bleeding, which means for all new office contract, you refuse to offer fixed rate. Instead, you say the price of your coffee will float based on the market cost. So first of all, you stop the bleeding, right? So for all the new office contract, you refuse to offer fixed rate. Instead, you say the price of your coffee will float based on the market cost, right? You offer the floating rate, no longer fixed rate, right? Second, what about the old fixed contract? Yes. What about the old contract? You go to the financial market and buy a special insurance contract, right? You go to the financial market and buy an special insurance contract that pays you when the bean price goes up. When the bean price goes up, right, that will pay you, balancing out your loss. In banking, this insurance is called interest rate swap. This insurance is called interest rate swap, right? And you are swapping your fixed risk for a floating reward. What you are swapping? You are swapping your fixed risk, that the coffee bean price will increase. You are swapping your fixed risk for a floating reward you are getting is floating. Okay, so what is the memory trick? So whenever you see a question where bank is losing money because they are stuck with the fixed rate while market costs are rising, remember this simple rule, that when you are in a fix, you must float and swap. Whenever you are in a fix, right, what you should do? You should float, and plus you should swap. So float means what? Make all the new loan floating. Let them ride the wave of rising rate so you earn more. Whenever you see this word float, float simply means let them ride all the loan ride the wave of rising rate. Okay, so that you earn more. And whenever you see this word swap, swap means use interest rate swap to protect your old fixed loan, right? Use IRS to protect your old fixed loan. That is the meaning. Okay, now let's come back to this question. So basically, let's look at our option. Option A, increasing the marketing budget. So that will make our problem very worse. Option B, restructuring the liability profile by increasing reliance on short-term bulk deposit. See, what it will do? It will just increase your expensive short-term deposit, because short-term deposit are getting time by time expensive. What about option C? Revise the pricing strategy by for a new loan to the floating rate and hedge. Yes, exactly. Right. So option C is the perfect business owner solution. You revise the pricing strategy for the new loan to floating rate and you hedge the existing risk under the using the IRS. Okay. So the correct answer is option C. Remember, in a fix, float and swap. Keep this analogy in mind and you will never get this ALCO question wrong. Now, friends, have a look at the question number 3. Before moving to the question number 3, let me introduce you to our Strategic Management and Innovation in Banking Certification course. In this course, this is a one-stop solution for all your need, for so that you can clear the examination in very first go. We have previous year question available paper. Each paper consists of 20 to 30 questions, which I have collected from those aspirants who have appeared in the examination. Along with full solution, you will be able to get to know what are the important topics. In addition to that, we provide you theory and MCQ PDF. There are almost 4 modules. Inside each module you get separate unit. Inside each unit you get separate theory and MCQ PDF. All these PDFs are downloadable. You can access them on WhatsApp, on your mobile, as well as on your web version. Both are available. For more detail, you can WhatsApp me on the number shown on the screen in the description section, or in the link of the course has also been added in the description section. Now friends, let's switch our focus to the question number 3. So basically what it is all about, this is the scenario. A bank want to catch credit card fraud. Okay, they want to catch the credit card fraud, but instead of just looking at the regular transaction amount, they are analyzing unstructured data. Yes, so they want to catch the credit card fraud, but instead of looking at a regular transaction amount, they are looking some unstructured data like social media feed, customer geolocation, website click stream in real time to detect an anomalous credit card transaction. So they are analyzing like social media feed, GPS location, etc., etc., and they are doing friends, that is what we are talking about. The bank want to catch credit card fraud, but instead of just looking at the regular transaction amount, they are analyzing unstructured data like social feed, customer GPS location, website click, and they are doing all of this in real time to stop the fraud exactly when it happened. The question asks which two fundamental characteristics of big data are most prominently leveraged here: volume visibility, velocity variety, veracity value, and variability volatility. Very good question. So let's step out of the digital world and think like a detective solving a case. Normally, a bank data looks like a neat, organized spreadsheet, isn't it? So when we talk about the bank data, they look like a neat and organized spreadsheet. So just date and amount, etc. But in this scenario, our detective bank is looking at a mix of completely different thing. What they are looking at? They are looking at tweet. They are looking at GPS, right? GPS ping from mobile phone. They are looking at on a click on website. These data they are looking at. These are completely different format, right? These are the different format of information. In big data, when you mix different type of data together, when you mix different data together, right? That's called, we call it variety. That's called variety. Now imagine our detective only figure out the crime a week after the thief escaped, right? They figure out the crime a week after the thief escaped. That is useless for fraud, right? To stop a stolen credit card, the detective need to process those clues and catch the thief the exact second they try to buy something. That blazing instant speed, that is analyzing data in real time, is what we call, velocity. Again, I am repeating. Suppose that our detective only figured out the crime a week after the thief escaped. That is useless for fraud. To stop a stolen credit card, the detective need to process those clues and catch the thief the exact second they try to buy something. That's called real time. That analyzing data in real time, that is called, velocity. Okay. So different type of clues give us variety, and catching the thief instantly give us velocity. Different clues, variety. Catching thief instantly, velocity. So to lock in this to your memory for the examination, just link these two simple words. So remember, real time. Real time, you can link it like vroom. Vroom means, velocity. Think of a sport car. Velocity is all about the speed of data moving in and out instantly. And then you can think of the unstructured and different source of data, right? You can think of them as various, or you can call them variety. Okay. So think of a buffet. You have various type of food like text, video, location, data, cake. It's not just one thing. So if you look at the final answer to this particular question, it is what? Option number B. They are looking at velocity and variety. Just remember, various source give you variety and vroom real time speed gives you velocity. Keep this in mind and you will be easily score this mark. Now friends, let's look at the next question we have. So next question is regarding the, so basically here is what is happening. There is a bank called ABC Bank. They get some great news. ABC Bank gets some great news. The RBI is changing the regulation and which will allow the bank to sell a highly lucrative new wealth management product. Yeah, so that they can sell the highly lucrative new category of wealth management product. But there is a catch. The bank board realizes that their own core bank IT system is too outdated to actually handle this complex new product. The board realized that their current IT infrastructure is too outdated to handle such complex product. So the question asks, in a standard SWOT analysis, SWOT analysis, strength, weakness, opportunity, threat. In a standard SWOT analysis, how should these two factors be categorized respectively? Option A, strength and threat. Option B, opportunity and weakness. Option C, strength and weakness. Option D, opportunity and threat. So they want to check whether you know the SWOT analysis completely or not. Very good question. Imagine, so let me give you a simple example to make it crystal clear. Imagine that you hear an announcement on the news that a nearby gold mine, right, is allowing anyone to come and dig for free gold. So a nearby gold mine is allowing anyone to come and dig for free gold. You did not created the gold mine. You don't control the rule. It is an external event that give you a chance to get rich. Obviously, once they get the gold, they will get rich, right? So it is an external event that give you a chance. So what is giving you a chance? External event are giving you a chance to get rich. In business, external chance to grow or make money is something we call opportunity. External chance to grow big and to earn money is called, opportunity. This is exactly what the RBI regulatory change is. The bank did not make the rule, but it is massive external chance to increase the profit, isn't it? It is a massive external chance. But then you look into your garage and realize your only shovel is broken. You realize that your only shovel is broken. That is your problem. It is something inside your house that is failing you. In business, an internal flaw or limitation is weakness. Suppose you look into your garage, right, and realize that your only shovel is broken. So this particular thing is your own problem. That is something internal. That is something inside your house that is falling you or failing you. In business, an internal flaw. An internal flaw is called weakness. So we have seen opportunity, we have seen weakness, right? So that is the bank outdated IT infrastructure. It is their own internal system holding them back. So remember, when you are in the examination, always ask yourself one simple question: Who controls this? Just ask this: Who controls this? And this will give you the answer. Suppose, so if you look at the strength and weakness (SW), right? They live inside the bank. Strength and weakness, they live inside the bank, like IT system, like staff quality, like capital. If you can fix it internally, then it is S or a W. And the second case we have is the opportunity and threat, O and T. So that this is the outside part of the bank. Okay. So I like RBI rule, government law, the overall economy. If the world does it for you, does it to you, it is a O or it is a T. So if you do it internally, it is S and W. If the world do it for you, it is O and T. Clear? So now let's apply this particular rule to our particular case. In this particular case, so friends, let's apply our rule. The RBI regulation is outside and it bring money, right? that RBI have made some changes, and it is outside, and it bring the money. So that's called RBI regulation is called opportunity. Something that is outside is called external, is called opportunity, right? And the outdated IT system, if you look at the outdated IT system, which is outdated, right, it is on the inside and it is broken, which means it is a kind of weakness. Okay, it is inside, it is broken, it is weakness. Therefore the correct answer is opportunity and weakness, right? So keep the in and out rule in your mind and you will never miss a SWOT or question again. I hope this is crystal clear. Option B is the correct answer. Now, friends, let's switch our attention to the next question. It is a very good question. So, the bank has a massive gross NPA of 5,000 crore, and the bank decide to take some of its operating profit and drastically increase its provisioning coverage ratio. Right? They want to decide to substantially increase the provisioning ratio from the operating profit. So now here is the catch. The most important line in the question. Right? They do this without achieving any cash recovery or asset upgradation. You see, this is the very important line. Without achieving any cash recovery or asset upgradation. Right? The question asks, basically, what will be the direct strategic impact of this action on the bank asset quality metric? Option they have given that both GNPA and NNPA will decrease. B says that GNPA will remain unchanged but net NPA will decrease. C says that GNPA will decrease but net NPA will remain unchanged. And D says that GNPA and NNPA will remain unchanged but the profitability will increase. It's a very good question and very conceptual question. So friends, imagine let's completely step away from the banking formula for a second. Let's imagine there is a leak in your roof, right? There is a roof leak, pouring water into your living room. Okay, pouring water into your living room. The actual hole in the roof is the GNPA, gross NPA. It's the root problem, right? It is the root problem. That is the hole in your roof, right? So this is a root problem, that the money that is physically missing because borrower stopped paying, right? It's a root problem. That means our borrower, they stop paying. They are no longer paying. Fine. Now to stop the water from running your floor, you place a large bucket under the leak. What you place? You place a large bucket under the leak. So that bucket is your provision. That bucket is your provision. It is a safety cushion you create from your profit to absorb the damage. Safety cushion. It's act like a safety cushion you create from the profit to absorb the damage. Okay. So the water that still misses the bucket and damage your floor, that is your net NPA. Yeah, there are some droplet of water that misses the bucket. It does not fall into the bucket and it create and damage your floor, ultimately damaging your floor. That is called NNPA. NNPA is called actual, right, your actual exposed risk. In this exam question, the bank decide to use a bigger bucket. In this particular question, what the bank decided? Bank decided to use the bigger bucket, right? Increase with PCR. They want to use a bigger bucket. That is increasing the, so bucket I told you PCR provisioning. So they increase the PCR provisioning coverage ratio. Does getting a bigger bucket magically fix the hole in your roof? Absolutely not. Because no cash was recovered, the hole in the roof remain exactly the same size. But does the bigger book reduces the amount of water hitting your floor? Yes, because your safety cushion is large, your exposed risk shrink, right? So how to remember it? If you panic in the exam hall, just remember the safety net rule. Just remember this safety net rule. This is the clearest example to understand the GNP and NPA. Safety net rule. So gross, when I say gross means ground reality. So so gross only changes if the real cash come back or loan is upgraded. No cash, which means no change in the gross. If the real cash either gives out, either comes or either goes away, then only gross. And then what is the net? Net is the safety net. If you talk about the net is the safety net. Safety net means it is simply the gross NPA minus provision, right? If you increase your provision, your safety net increases, your net NPA automatically drops, right? Now let's look at the option that they have provided. What is the first option? Both GNPA and NNPA will decrease. Sir, because there was zero actual loan recovery, the GNPA cannot change. GNPA will change only when you undertake any kind of measure like cash recovery or asset upgradation, but you did not do neither of them. So that's why GNPA never changed, right? But because they increase the provision, so net NPA is reduced. Yes, the provisioning they have increased, right? So net NPA, which means less amount of water hitting the floor, damaging the floor. So therefore, the correct answer is GNPA will remain unchanged, but net NPA will decrease, right? So I hope this is crystal clear. Master the logic, and you will easily secure your mark on asset quality question when they are asked in the examination. Now, friends, let's switch our focus to the question number 6. Very good question it is. So basically, this is how the setup look like. Global bank want to completely upgrade its cross-border trade finance operation. They want to upgrade or overhaul their cross-border trade finance operation, right? So basically, to do this, they are implementing blockchain technology with their partner bank around the world. But they are implementing blockchain technology with their partner bank around the world. The question asks, from a strategic operation perspective, where is the what is the most significant, global bank want to completely upgrade its cross-border trade finance operation. To do this, they are implementing the blockchain technology with their partner bank around the world, right? So they are updating the blockchain technology. The question asks, from a strategic operation perspective, what is the most significant advantage the bank will achieve through this implementation? Option A, completely elimination of the currency exchange rate fluctuation. Then guaranteed zero profit default rate on international letter of credit, creation of a decentralized immutable ledger that reduce reconciliation time, and bypassing all central bank reporting and AML requirement for cross-border transactions. These are the four options they have provided. So think about, let's completely drop the IT jargon here. Let's completely drop it for the time being and think about how traditional international trade finance work. We're talking about the trade finance. So, trade finance is like a slow, painful game of passing notes. It is quite slow. It is quite painful, right? Slow and painful game of passing notes. A buyer in India send a paper letter of credit to bank in London. So this is India. India, there is a buyer, and what he does, he send a paper letter of credit to to whom? To a bank in London. Okay, to a bank in London. So the London bank has to manually check their record against the Indian bank record. So obviously, this London bank has to manually check the record, right, against the Indian bank record. So this manual checking, which means making sure that my notebook matches your notebook, is called, reconciliation. This manual checking is called, reconciliation. That means my book is matching your book record, right? It takes day and words, a scammer can easily forge a paper document, right? One scammer can easily forge the paper document, right? Now imagine replacing all those private notebook with one giant indestructible glass whiteboard placed in the middle of the world. So you are replace all those notebook. You have replaced all those notebook with what? With a giant, indestructible glass whiteboard. And where it is placed? This is placed in the middle of the world. Every bank can see this whiteboard at the same time. Each bank, can see this whiteboard whiteboard at the same time, and that is called, decentralization. You have replaced those notebook, right, with a white giant white book, right? Every bank can see at the same time. That's called decentralized. And when a transaction is written on this board, so this is a board, and suppose I write a transaction. So transaction is written on the board, right? It is carved into a glass permanently. It is carved into the glass permanently, right? And no one can even erase it. It is non-erasable. It cannot be erased. No one can even alter it. No, it cannot be changed. This is called, immutable. This is called what? Immutable. Sir, because everyone is looking at the exactly same permanent board, there is no need to waste day checking my notebook against your. Why I will check my note? Because, everybody is looking at the same permanent board. So there is no need to waste days checking my notebook against your. So the reconciliation time drops to zero. So this is the consequence, and this is the advantage. Reconciliation time, is drops to zero, right? And because no one can alter the glass, document fraud become nearly impossible. So to easily spot the correct blockchain answer in your exam, Just remember the trick that blockchain remove the dirt. Blockchain remove the dirt from the messy banking paperwork. It remove the dirt from the messy banking paperwork. Now you will ask, sir, what is this dirt? So see, D stand for decentralized, which means shared by everyone. Decentralization means what? It is shared by everyone. That is called decentralization, not hidden in one bank. And then I means what? Immutable. I means what? Immutable. Immutable means carved in stone, cannot be faked. Immutable means carved in stone, you cannot fake it. And then R means, reduces time. Reduces time, which means instant verification, no slow reconciliation. That is what DIR, decentralization, immutable, is it will reduce the time, right? So look at the option. So can a software system magically stop currency value from changing? Tell me. Option number A says that elimination of currency exchange. Tell me, can a software system magically stop currency value from changing? So no. Option A, eliminated. Now tell me, can a software guarantee a human won't default on a loan? Again, no. Right, again no. Eliminating option B, 0% default rate. Now, option C. Now, before that, option D. Can a bank legally bypass the RBI and AML law? Again, it is no. Never. Right. But it can erase our indestructible glass whiteboard. Yes. The correct answer is option C. So, creation of a decentralized immutable ledger that reduces reconciliation time and mitigate the counterparty document fraud. So remember this DIRT trick just now we have discussed, right? And you will nail those technology question every single time, right? I hope this is crystal clear. Now, friends, let's look at the next question. The next question is we have, you know, basically a retail bank has a massive database of customer transaction history. Massive database, customer transaction history. They want to find hidden pattern and group these customer together for targeted marketing. But here is the most important line in the entire question is that the bank does not have any predefined categories or level for these customers beforehand. So the question is, which data mining technique is most appropriate for this strategic move? Option they have given: classification, linear regression, clustering, and time series forecasting. Data mining is a very important topic from examination point of view. So last time, case studies were asked related to the data mining, right? So let's step out of the IT department and think about sorting the object. Let's step out for the time being IT department and think about sorting the object. Imagine I give you a standard deck, right, of playing cards, and you start and ask you to sort them, and you were given the task to sort them. Okay, you already know the categories before you even start. So you know about heart, you know about diamond, you know about spade, and you know about club, right? These are the four categories, right? So you are simply placing each card into pre-existing bucket. So you take one card and you place into either of the bucket. That is what you are doing, isn't it? So in data mining, when you already know the level beforehand, that's called classification. So if you know the level, that is called, classification in the context of data mining. Right. Now imagine that I give you a ball of strange mixed candies. So I give ball of, right, candies, mixed candies, right? And from a foreign country. You have no idea what is the flavor. You have no idea of the flavor. There are no level are available there. So there are no predefined category here. So what you will do? You start grouping them based on, hidden similarity. So you will group, but how do you will group? You will group at their hidden similarity, right? So these are round and red, let's put them here. These are square and blue, let's put them here. So you are creating natural group from scratch. So in this case, what you are doing, you are creating natural group from scratch, right? So in data mining, when you group things based on similarities without having any predefined category beforehand, that's called clustering. The word is what? Clustering. See the difference between classification and clustering. In the case of classification, we were having the predefined categories, but in this case, we don't have any predefined category. You are just categorizing them looking at the similarities without having any predefined category. That's called clustering. Okay, so what is the memory trick? To never confuse these two in the exam hall, just remember the word play. So when I say clustering, think about clueless. You are completely clueless about the category beforehand. You have no level. So since you have no level, so just create cluster based on what looks similar. And if we talk about the classification, if we talk about the classification, right, it is classes. These are, classes, which means you already have the classes category defined before you ever start sorting. What is the final answer to this question? Yes. Let's look back to our question. The bank does not have any predefined category clearly mentioned or level for those customer beforehand. Yes. The correct answer is clustering. Option number C, clustering. Right. If you look at the option A, classification, it would be right if they already know the level. If you know the level, then classification will be right. And option B and D, are for practicing predicting number and trend, which does not fit here. So just lock in. Whenever you are clueless, just tick the clustering, right? Clustering trick, and you will easily secure your marks. Friends, we have some more questions available, and that will be available in our paid course. If you want to get access to those questions, you can enroll in our course. For more detail, you can WhatsApp me on this particular number. You can check out our course for more detail. Thank you. Have a very nice